Is the live stream. We're going to be talking about a few things. The best investment in the retail space today, and then we're going to talk about, as we do, kind of the macro environment, macro kind of current event stuff. A couple of topics. One is the retail railroad strike, and then the other one is regulatory capture. A lot of the regulatory concerns around privacy and privacy for tech companies. So let's begin. Why don't we start off with the railroad strike issue, Hari? Did it get resolved?
So it hasn't been fully resolved yet, but it looks like it's getting closer. The government stepped in and kind of to help out. And I think, for people who are not really familiar with rail, there's a lot of industrial goods that are transported via rail. And there's a huge chunk of things that are only transported by rail that had they been disrupted would completely disrupt supply chains for a lot of different industries, right? So this is a huge disruption to the economy if this doesn't get resolved in a amicable way. I mean, and so that's the biggest concern right now, is that we're already under a tight economy, tight strain, and then if this happens again, we now have an even bigger problem, right, to deal with.
Mm-hmm. Yeah. So just to frame this, right, is a lot of goods are transported across the country by railroads, and that's why Buffett was famously interested in buying a railroad company, because it was sort of this perfect kind of Buffett play, right? I guess we have a question from the chat. Jacob, is BNSF impacted by the railroad strike?
So yes, the short answer is this impacts all. What the actual disagreement is, the labor unions that are providing rail employees to Amtrak, to the BNSF, to all of the major carriers are striking for higher pricing and for higher wages. And so it actually impacts everybody. So the disruption is fairly significant here if there is because it can hit basically everything all at the same time.
Yeah. My question is, as with these strikes and unions and things like that, from a company standpoint, if your labor pool that operates the company is going on strike and demanding higher prices and things like that, and if this kind of pressure continues to mount, and the technology, especially around AI and computer vision and things like that, gets better and better, what is it? It just puts a lot of pressure on the management to actually say, we're gonna put machine behind that train instead of human. I suppose labor is there to kind of thwart that, but it's just going against the natural evolution of tech. And this is just not really a formed thought, but just something that just came to me.
Well, I think what you're trying to get at here is there's a couple of things that are coming out of something like this, right? One of them is, this kind of came out of left field, right? The last week or so, it's suddenly people are starting to talk about it. And what I would say about these things is, when you talk about older industries, almost all of them have some sort of potential disruption with employees if they have labor unions associated with them, right? Because it means suddenly the business that had operated can shut down, and so that can have a huge impact on your financials, right? And so that's why when we look at the checklist, we always have questions about where does everybody sit with their suppliers, with their um, there are various different groups, because if we
Yeah.
yeah. Oh,
And
sorry.
by the way, I mean everyone, like investors know this, as well as the execs know this, that labor unions can be a drag on the company and can be kind of this um, can kind of thwart or kind of interject in the way of making progress that management wants to. And we can debate about whether this is meritable or not, but they all know this. So in 10K they actually say explicitly, if they don't have unionized labor base, they will say it as sort of like almost like a value proposition, like a marketing copy.
Yeah.
Look, we don't have to deal with unions, come buy our stock. So I mean, it makes sense.
Well, and imagine, because this is the next topic we'll also talk about, is new industries like Amazon and things like that. They don't have a highly unionized labor force, right? um, but older industries do. And when the disruption happens, you as an investor don't necessarily know that these things are coming, right? Like, you can't, I mean, you may know where their contracts ends if they talk about it in the 10K or something like that. But if you don't, right, it could be the end of your business, right? And um, or a significant price shock to your business. Now, the flip side of that is the long term prospects of the business may not be interrupted by this. So it's also a buying opportunity, right? So if this does happen and the railroad companies get a huge hit, right, it may be a great opportunity to buy a business that's been around for you know a century, and is only getting more consolidated and more profitable over time, right? Um,
We have another question from Jacob. Some have implied this could start a domino effect. Are you concerned about that?
yeah, absolutely. Like, I think that's a huge concern, right? Um, if the if what we start seeing is a trickle effect from supply chains being disrupted because of heavy industrial goods, then that impacts so many different industries. It impacts oil and gas. It impacts um, you know distribution of heavy materials, housing. All of these things are being transported via rail, and so suddenly all of these other industries no longer have inputs of goods to actually do their to for their output. So it's a pretty big deal. Um, like, I think secondary to oil and gas disruptions, I think train is probably number two, right? Because it's basically impacting your supply chain within the country.
Yeah, this kind of goes. I want to make this comment, and then let's move on to the next one, which is this strike reminds me a lot about during COVID, or after COVID, when we were coming out of COVID crisis, and there was this massive demand, right? Like everybody wanted stuff, and everybody was going out and eating and stuff like that. Uh, uh, Most of the goods that we import in this country in the U.S. come from China, and so the ports had a lot of leverage over this because it was sort of the bottleneck that every goods had to go through, especially in California, because a lot of the ships dock over in California, and then all the goods are being transported by the train system, or by trucks and things like that. They also went on strike. I don't know if you guys remember. So um,
Yeah.
it almost seems like a quasi government entity, right? It's like it's so kind of old and sort of entrenched that you're not going to get a incumbent that's going to disrupt the railroad industry, or like the port
Hmm.
industry. So they're sort of very entrenched. You have this sort of government like you know labor base that's like very heavy and doesn't move very nimble, and they're anyway, it just makes me think about that. And um yeah, just a thought as a parallel there. Let's move on to the next topic, um which is regulatory. I mean, it's related to it. But before we go, we have a question. Interesting thought on oil and gas from Jacob. When Keystone was suspended, that gas traffic ostensibly went to rail.
Yeah,
Yeah.
it's a I think when a lot of coal for power plants is transported via rail. Here in Houston, we burn coal for at the power plants, and that's what most of our energy supplies come from. So,
Is it really in Houston?
yeah, yeah,
Interesting.
you can actually go see the train out in Rosenberg area.
Not oil, not gas. It's coal.
It's coal.
Interesting.
I mean, that doesn't mean that there aren't other types, right?
Right,
But
right,
the
right. That's what I'm
majority,
saying. Majority is interesting.
yeah. And so when you start talking about, because moving coal, it's not cost effective to do it via truck, right? You're having to do train loads a day of coal just to make the for the coal plants and stuff like that. So the biggest thing about trains, I think, that people may miss is that energy is actually what's transported via train, right? Like the input goods that you use for your energy, uh, especially the old style energy, coal, natural gas, those kind of things. And to Jacob's point, when the Keystone pipeline was shut down, they basically just moved it to a less efficient. I mean, compared to a pipeline, the train is actually a lot less efficient, right? Because a pipeline's already laid in the ground. You're not moving a huge train. But if that gets disrupted too, now you're suddenly at a loss for how you're going to move all of this oil from Canada down to Texas for refining and stuff like that.
Mhm. Yeah. Interesting. Just a random thought. Why is it called natural gas, not just gas? It's almost like
Uh, uh, they got to call it something, I guess.
yeah,
Something just to distinguish it.
yeah. Okay. All right. Let's move on to the next topic, which is regulatory capture. Okay, this is something. This is something that I have been noticing a lot, which is that you got a lot of these headlines coming in. I mean, this is not new. Everybody who's probably listening to this podcast are aware that a lot of these tech companies, not just tech companies, but a lot of companies, they go out and they grow and they're very profitable. They're out there operating in all kinds of jurisdictions all over the world. And as they grow, the regulatory pressure mounts. And what I mean by regulatory pressure is, I mean governments and jurisdictions all across the world, they're trying to get a piece of the pie of their success, basically tax revenue. And they get around. These companies are very sophisticated. They have armies of lawyers to combat that, and CPAs and whatnot. And so that they bring up additional issues to get at their coffers. And one of which that I'm noticing a lot, and this is not a new thing, is privacy concerns. Right? It's like you go scroll through Wall Street Journal and you'll see in articles. It's just every so often you'll see these articles that talks about privacy concerns and at different jurisdictions and trying to get after this pot of money that they're going after. And I just want to make a comment on this phenomenon, which is like what I said, regulatory capture. So as companies grow and mature, their profit margins naturally decline because of capitalism, right? So as the profit margin declines, and why is it declining? It's declining because if the capitalism is supposed to work as it's designed, you have new incumbents trying to disrupt that profit margin. If a company is making so much money, then why wouldn't I start a company that would go after that pot of money as well? So the profit margins go down. But another thing that sort of contributes to this is regulatory capture. And this is kind of a parallel here from the first topic, which is the labor unions. That's another thing, right? As the companies grow, the profit margins sort of shrinks because all these different stakeholders want a piece of it. And so I just want to point that out as a way for government to get a little piece of it. And I suspect because of the cycle that we're in right now, this is kind of a macro take, governments all over the world are drowning in their own debt. And so they're scrambling to find revenue streams, and they're just hitting these companies with like fines and this and that because they need to survive themselves as well. And the only way that, governments make money is by taxing people and doing these things. So I suspect that this is not a trend that's going to go away. It's probably only going to accelerate. Um, yeah.
I think, yeah, I mean, a good example of this is Amazon is being sued by California for antitrust violations, because they're saying this was just announced this morning. The front page of the Wall Street Journal was, uh, that Amazon is basically colluding with, merchants, or preventing merchants from offering their prices lower in other places. And obviously, if you sell your things on Amazon, you're taking a lower percentage because Amazon takes their cut, before handing it over, right? And the funny thing is, when Amazon started, right, their biggest selling point was they were cheaper than other places. And then you could actually see then they slowly normalized their price against what other sellers were offering. Um, and now they're being, people are saying that they're actually overcharging you, right, for things, right? So it's a funny thing because the old story that changed, right, was Amazon ran in an unregulated environment. It was kind of the Wild West when they opened up, and then it just continues to get more and more, more and more, targeted because maybe they are doing what they're being sued for, right? But I think this regulatory capture stuff that you're talking about, like the railroad industry had limited regulatory stuff when it started, right? And there were hundreds of businesses, and then as they consolidate and they get bigger, the government targets them, and you get more, taxes on rails, and you get more. But it also comes with, those industries will lobby the government to protect them against, so that they can protect against competition. So it's like a two-way street, right? So for a long time, in the 90s, Microsoft um, had no lobbyists, or had very minimal lobbyists on Wall Street, or in Washington D.C. And then when they got sued for antitrust violations, one of their responses was to put a ton of people on, in the lobbying force to protect themselves from getting sued in the future, right? So they basically bought their way out of this thing, right? But I think the larger point here is, as industries get consolidated, and as businesses start to consolidate like they are, right, it makes them larger targets, and then the government goes after them, and finds new ways to tax them because they need an ever-ending increasing supply of revenue, right? So you have to use that to your benefit, but when you're buying companies in new industries, you have to pay attention from 5 years from now, right? Is Facebook going to be in the same regulatory environment that it is today, right? If they're being sued for privacy violations and doing all of this stuff, it slowly erodes their profit margin, their business model, and so forth, right?
Yeah, absolutely. All right, let's move on to the company of the day, company of the week. Is this company the best investment in the retail space right now? Some of you listening to this, I'm specifically thinking about a couple people, may know the answer to this question, but what is it, Harry?
Well, so Academy Sports and Outdoors, the is ticker is ASO. So we actually talked about this on our the weekly or our monthly meetup. And if you're a member of the Slack channel, you'd actually have access to that link yesterday, and you could have actually joined us in this discussion. But what we actually talked about was we went through the entire checklist, and it was really a great discussion. But what I would encourage people to learn about with a company like this is, they operate. It's a very simple business. Their 10K is only like 60 something pages. And, I think you could get through it fairly fast. Um, but it's a business that has it's a, built or a company that was founded in the 1930s. They were private for a long time, and then recently IPO'd, and their new CEO has kind of really cleaned up the balance sheet, the business. They're highly profitable, and trading at a very reasonable multiple. And I think they have plans to grow. They're only in 15 states right now, so they have a long runway for growth. Um, so I think, to me, it's a great business at a fair price. It's a good bargain in this market right now. And they haven't been suffering from inventory issues. They even brag about that in their conference calls. Like they're not suffering like Walmart or Target is at this point.
Yeah. So Academy Sports and Outdoors, the ticker symbol. Let me flash my screen again. Here we go. Academy Sports and Outdoors Inc. Nasdaq ASO. If you guys want to check out their financials, feel free to do that at valueinvestor.org. You can just type in the ticker symbol here. What I think is interesting about this company is, I guess, this is a comment I was making yesterday. It's very, as with like local stores, if you're not digital native, you have to be confined by the limitations of geography. And retail store, you're sort of by definition have to operate within certain geography. And if you extend yourself beyond that, it's just going to come at a cost, and maybe it's just not as efficient. You just won't be efficient. So it goes to a point that I was mentioning yesterday, which is, we have this company that's pretty great. Now the question is, can it grow, or should it grow? Right? I think that's the question we were able to analyze. So if you look at this company, income statement looks pretty healthy, right? I mean, it's growing pretty well, and then it's trickling over to the bottom line. Okay, cool. Next, balance sheet. Balance sheet looks pretty healthy. Okay, so debt, it's under control. It's getting under control from 2.6 to 1.8. Cash balance looks pretty good. Inventory level is pretty managed. It's good. So okay, a quick glance, balance sheet pretty good. Cash flow, again, sort of good. Relatively low capex. Free cash flow is humming along, and so the company is doing pretty great. Now, I think the question is, what is this? What is the future of this company? And as a retail business, you have to grow. And the company said they're going to grow and expand to how many different areas? But I guess that's my question: is what is the growth and the catalyst for the company to grow, and then also the stock market appreciate like that? What is the catalyst for it to jump to a new high?
So I think, there's a couple of things. Is that their growth rate is, they've been talking about opening 10 to 20 stores per year, right, off of a base of 200. So they could potentially increase their store base by 6 to 10% a year going forward, which would help them quite a bit. But I think the bigger thing is that this is a company that just seems to be flying under the radar for a lot. So they have a strong shareholder friendly buyback in place. I think it was like $400 or $500 million. But they're so cheap. Like we've talked about this, before with lots of companies like Southwest Airlines and NVR, because they're buying back shares at such a low price, it's doubly beneficial, right, for you as the shareholder, because they're getting it at a discount, right? So I think they have, two or three different ways that they can return money to you. One is that they'll grow their store base, which will eventually lead to higher free cash flow. They're buying back more of their shares, and then they have announced that they're going to start paying a dividend, right? And so this is a company that's paying, trading at like 6 times free cash flow, for the year. It's hard to argue that this is expensive, right? And it's been around for 100 years almost, or 80 plus years. So it's not going anywhere, right? And they have a very able management that has done a really good job with this company. A former Foot Locker CEO or Foot Locker management guy who doesn't really seem to be, his incentive structure is to grow EBIT, right? Which is exactly what you want to see in a company like this, right? So everybody's aligned incentive wise. So now they just have to go execute on this, and I think everybody benefits, in that model.
Mhm. If you guys would like access to the checklist, we just quickly went through the checklist. But if you guys would like access to our checklist, just email us at info@valueinvestor.org. We'd be happy to share that checklist with you. In fact, let me quickly show you what that looks like. This is just a checklist that we go through to analyze companies. I think most people who are listening know, but here it is. Yeah, if you guys would like that, just give us an email, info@valueinvestor.org.
And then
Yep.
at the same time, if you'd like to join the Slack channel, we'd love to have you on there. We have fairly lively discussions on Slack. People post articles and comment on things that they're looking for. So, it's a great way for us to interact with you and for you to, get questions answered, challenge your thinking on, certain stocks that you're buying. You could talk about a company like Academy, or we naturally come up with, good ideas, through those chats. So it's a really good way for you guys to interact with us and for us to have, more, conversation, right? Beyond just our podcast.
Mm-hmm. Great. That brings us to the end. I wish we were able to get into a little bit more detail on these companies. There's rich material there that we could really get into, and perhaps we should structure the podcast so that we go back to the part 1, part 2, that kind of thing.
Yep.
But for now, we'll close out here, and please join me next week. All right. Thanks, everyone.